Thank you for watching this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps financial advisors, money managers, and individual investors understand the trend direction and the current level of risk in the stock market, allowing you to make better asset allocation, investment, and trading decisions, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, August 14th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. For the week, we were up 0.64%, so 64 basis points on the S&P 500, and we closed at 3372.85. The first chart that we're going to look at is a one-year weekly candlestick chart of the S&P 500. So each candlestick does represent 1 week of trading. The blue line is set at 3350. So the first thing I want to point out is this is the second week in a row, but only the third time in history when the S&P 500 has closed above 3350. So the importance of this is that we are now once again back up really at the all-time highs of the market. The highest daily close we've ever had on the S&P 500 was back on February 19th, where we closed at 3386.15. So we came right up to that level this week, and I'll show you that on the next chart. But we came right up to that level this week and kind of backed away from that. So that point may be acting as some overhead resistance. But the real point of me bringing this up and the fact that we're back up towards these all-time highs and really only closing on a weekly basis above 3350 three times in the entire history of the S&P 500 is now we are back up and doing this and closing above 3350 with 20 to 30% lower earnings than what we had back in 2019. So just keep in mind that as the market continues to go up, yes, the stock market has kind of recovered right back to these all-time highs, right at these all-time highs, but the earnings on the companies inside the stock market are still down at least 20 to 30% over where they were back in 2019. So the valuations on the stock market are worse than what they were a year ago. The pricing is higher, right? The price to earnings ratio is higher, much higher than what it was last year. So the value, right, the real value that's in the stock market, it's not near as attractive as what it was last year. The next chart that we're going to look at is just this last week's trading. So this is a 5-day, 5-minute candlestick chart. So each candlestick does represent 5 minutes of trading in the S&P 500. And the blue line this time is set at 3386. Now you may remember that on the previous chart I pointed out that the all-time closing high for the S&P 500 back on February 19th was 3386.15. That was on the daily close. And you can see here that on Wednesday, the candlesticks, we had a couple of candlesticks that went above 3386. So we got right to that all-time high and we challenged it intraday on Wednesday, August 12th, but we couldn't stay there. We couldn't close above that. And you can see here that we came right back up to this 3386 level again on Thursday the 13th and backed away from it. And you can also see in this chart, and this is really one of the most telling things in this chart, is that from where we gapped up on Tuesday, so obviously this is Monday over here where the cursor is circling, but where we gapped up on Tuesday, we basically traded sideways, right? And that's about where we finished on Friday at 3372.85 right there. And of course we finished just slightly negative by 2 basis points on Friday. But you can see here for Tuesday, Wednesday, Thursday, and Friday, we basically just traded sideways with some volatility, of course, but we had a lot of sideways trading action for the majority of this last week. What I'm taking from this sideways trading action is that, especially since we're right there at those all-time highs, it's possible that we're starting to see this market run out of steam, at least in the short term, and this possibly could be some stalling action where we might roll over the next couple of weeks. And I'll point that out here on the next chart. The next chart that we're going to look at is a 5-year weekly candlestick chart of the S&P 500, and the blue line again is the 3350. So this chart is really the same as this one here, except I have backed it out to where it is a 5-year time frame. And of course the orange line is still the 40-week moving average. And what we can see here is we're really extended above this 40-week moving average, and any time when you get this far away from the 40-week moving average, which of course is very equivalent to the 200-day moving average, but anytime you get it this far extended above the 40-week moving average, you are very vulnerable to a pullback. And you can see it here, right, where you get really extended above the 40-week, you pull back, oftentimes right to that 40-week moving average, not always, right? Sometimes you just pull down towards it. You don't get all the way down there, but many times when you move away from that 40-week, you get sucked back to it. You move away from it, you get sucked back to it. You move away from it, and then you get sucked back to it. And sometimes, as we saw in Q4 of 18, below it, we pull back to it here, pull back towards it, and kind of really came close right here. So the point is that, guys, now that we're back up to these all-time highs, right, we're challenging these all-time highs in the S&P 500. With, of course, much lower earnings than what we saw a year ago, that makes us vulnerable. The markets are more expensive. The price-to-earnings ratio has expanded. The valuations are not near as attractive now as what they were a year ago, and it's probably going to be another year or two before we see the earnings on the S&P 500 back to where they were back in 2019. So the fact that we're right here, the fact that we've only had a few weeks in the entire history of the S&P 500 where we've closed this high, and the fact that we're doing it on lower and lower earnings than what we saw a year ago, and there's still a lot of uncertainty around a lot of things that could affect the stock market. Obviously, the coronavirus, we still don't have a handle on this thing, guys. We're still learning about this thing. We don't have a vaccine, right? I'm not telling you anything you don't know, but there's still a lot of uncertainty. There's more and more companies going bankrupt, and there's going to be a lot more people laid off over the next few months. And this thing is still spreading, and within a few months, we're going to be going into the cold and flu season. So there's still a lot of complications around the economics on a global scale and how this all may play out. So just keep that in mind. Don't get too comfortable here and too complacent, because we're still vulnerable to a pullback. And so at this point, it would not surprise me to, over the next few weeks or few months, to see us pull back towards, or right to perhaps, this 40-week moving average, and that would take us down to some support levels that we have down, around the 3,000 level as well. So there is some support at 3,200, but the larger area of support from where we're at right now is going to be found around that 3,000 level on the S&P 500. So kind of keep that in mind. And again, just remember that when you get this far away from the 40-week moving average, it is not uncommon at all to pull back to that 40-week moving average. So only time will tell if that is going to be the case, but just kind of keep that in mind and be prepared for the possibility of a 10 to 12% or so pullback that would bring us down to somewhere close to this 40-week moving average, or slightly below it, down towards the 3,000 level on the S&P 500. I'm not saying it's inevitable, but it is definitely possible over the next few months. And the next chart that we're going to look at is a 5-year weekly candlestick chart of the triple Qs, for those of you that like to track or trade the Nasdaq 100. And the triple Qs, of course, there's a lot of very hot, quote-unquote, hot stocks in there. There's a lot of growth in the Nasdaq 100, and we know that the Nasdaq 100 and the stocks within the Nasdaq 100 have really, up until the last few weeks, been kind of the leadership area of the stock market. It's been the fastest growing area of the stock market and has really rebounded very quickly from the bottom back in March. And of course, we're well into all-time highs on the Nasdaq 100. And this gap here over the 40-week moving average, the 40 on this chart is a blue line. You can see that this gap above the 40-week moving average, that is over 20% on the triple Qs. Guys, when you get that far away, again, you can see that you pull back, right, to the 40-week moving average. And over the last really month, the triple Qs have kind of underperformed the overall market. So we were up only 25 basis points on the triple Qs this last week. A few weeks ago, about a month ago, we had a couple of negative weeks in the Nasdaq 100 and the triple Qs. So we're seeing some stalling action here. We're not getting the same price performance. We're seeing underperformance on the triple Qs on a relative basis really over the last month. So that's another area that I'm watching, where there's the possibility, it's telling us, right? The market is talking to us. The market is potentially telling us that we're running out of steam here and getting ready to possibly roll over the next few weeks, or at least the next few months. Also, guys, don't forget, we are in the worst 3 months of the year historically for the stock market. August, September, October traditionally happen to be the worst 3 months of the year for the stock market. Over the next few months, of course, we've got what's going to be probably a very contentious U.S. presidential election, so we're facing that. We're still battling with the coronavirus, which is spreading at a very rapid rate. So we're dealing with a lot here, and we're doing this on much lower earnings than what we had a year ago. So it's been absolutely incredible how resilient this stock market has been. But it would be unrealistic for us to expect this market to continue to climb and climb and climb and climb at the run rate that we've seen over the last few months without some type of a pullback. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. we know that we came into the year with a strong stock market. So we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and then we know that we hit the all-time high on February 19th at 3386.15. That is the closing high so far on the S&P 500. And then we had this intraday reversal on Thursday, which I talked about in my Simple Market Signals newsletter, which of course is how I disseminate the signals. And then we closed lower on Friday again. And so what we can see here is, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over, and that that things were changing. And so I gave people a heads up right here over the weekend. And I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal. We had the general trend indicator went negative. And then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, okay? And it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October, all right? So that thing had been positive for, 5-6 months, and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signal subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.